Well, let's get started with the elephant in the room. I think it's a question we get the most, which is why are the junior miners lagging the other parts of the industry? Here's a chart that goes back a little, all the way back to about May 30th of 2023. That was a time, as you can see in this chart here, was a time when the TSX Venture actually broke down their index into subgroups of the precious metals industry, which allows us to sort of see here how has been the performance of this part of the industry, which majority of them are small cap companies. And you can see here that they have significantly lagged other parts of the industry, even the commodities themselves, gold, silver, and even the senior miners. And I think it begs an important question: why is this happening? So let's break it down and some of the reasons that we believe are causing this lag. Let's go to the next chart. So the first one is that this is normal. It's a normal phenomenon. I think Quinton had a slide in a few weeks ago in which he had how capital tends to flow into gold first, and then you see copper and silver and other precious metals that are linked to gold itself, and then base metals as well. And then you see the seniors, and then finally you see the money flowing into the smaller parts of the industry. As Kevin likes to say, the lag is your friend, and I would totally agree with this. I don't think what we're seeing is anything unique. It's something that we've seen in the past, and it's a matter of time, in our opinion, for the capital to finally flow and be attracted by a higher risk, but also higher potential for returns, which is mostly in the junior mining space. I think the second thing that's been happening is investors have had many failed attempts trying to mark a bottom in the junior space. And I think understandably, they're very skeptical about this industry. We also know how some of those companies, and majority of those companies, have carried their capital allocation in a terrible way over the years, and also depleting cash for I would say a very misallocation, very large misallocation of assets overall, that I think cause as well some of those issues. But those are usually great opportunities to be looking for an activist role in this space. So let's go to the next slide. Is this time different? I think this chart is a great chart just because it shows the cyclicality. I don't think there's a lot of industries and I should say a lot of asset classes that shows this cyclicality so well illustrated in a chart like the commodities to equity ratio. No, I don't think this time is different, but investors tend to believe that would be the case. And history doesn't necessarily repeat itself, but it does rhyme. And I think we're in a moment right now that is very pivotal, in which a lot of investors are throwing in their towel and saying this industry is worthless, and I'm never going to deploy capital into the space. Unfortunately, we've had the news that Stransberry today actually was, I guess, announced that they're not going to be covering gold stocks anymore. All those things are starting to happen in the space, and I think people are still very skeptical about gold itself, although things have changed, at least in the last few months, with the purchases of central banks that have become more and more evident. However, the junior mining space continues to be very neglected and hated, which is, to me, a sign of opportunity. So no, I don't think this time is different at all. I think investors tend to think that what's happening today is unique relative to history, but we've seen something similar to what we're seeing today. And let's dive into why we think that that's the case. So let's go to the next chart. I think so far I haven't answered one of the main things, because yes, if they're lagging, because the lag is your friend, and that's common, and that's very normal phenomenon to see if you enter the beginning of a cycle, or the second option, in which I think that the first thing we need to understand is if we can check the box of being in a secular bull market for gold or not. So I'm going to offer a few bullet points that I think kind of fall into the category of why do we think with so much conviction that this is actually the case, and maybe why investors have been so skeptical about this industry are poised to be wrong-footed here in this space, and therefore why we've been allocating capital into this industry. Let's go to the next chart. So now that we're going to dive into the reasons why we think we're in a gold secular bull market. Well, we've seen central banks buying gold recently. I've used this chart before. I don't want to overuse it, but I think the point is such a fundamental part of the thesis is the fact that we've seen central banks buying record amounts. But when you put that in historical context, we just haven't seen anything yet. Back in the 70s and 80s, I should say the early 80s and late 70s, as you can see in this chart, clearly central banks used to own about 75% of their assets in gold. And today we're below 20%. In fact, it's about 19% to be exact. And now if we go to historical average at 40%, it's a double from here. So that's one main part of it is that this move is in early stages, in our opinion, because central banks are likely to be one of the main drivers of the price, and they have been recently, but they are just starting from our measurements of how much they own of the metal relative to history. Let's go to the next chart. Well, the other thing has to do with the second large pool of capital that we know. It's 60-40 portfolios, in which they also go to their own cycles. I mean, if you look at the cyclicality of the earnings yield of the 60-40 portfolio, so what does that mean? This is just looking at the valuation history of a 60-40 portfolio, basically given a 60% weight in equities, 40% in fixed income. In this case, we're using treasuries as the fixed income and the S&P 500 as the 60% allocation in equity. And you can see from an earnings yield perspective, this is one of the most expensive portfolios we've seen in history of this portfolio itself. And prior times we've seen this, we've had big movements to the other side, meaning capital actually started to flow out of those two asset classes and into other things. And commodities and hard assets are likely to be the ones receiving those funds for many reasons. But that's the second reason why I think that we're entering a gold market, is because those traditional portfolios are yet to start buying the metal as well. Let's go to the third one. Here's another one, because those folks, they're usually, traditional portfolios usually managed by a portfolio manager. And those folks usually tend to prioritize volatility. And this is the first time in 45 years that gold has a lower volatility than treasuries. This is basically what this chart showing you. It's measuring the 7-year rolling downside volatility differential between gold and treasuries. And you can see this is the first time that treasuries actually are more volatile than gold. Every time it declines further relative to gold prices. And this is such an important chart, given the fact that as we see that happening more repetitively, which has been the case. I'm old enough to remember the days when people used to say gold can never rise with interest rate rising. And guess what? The opposite has happened. And I think that's precisely the case here as people start to favor a new asset class as part of their defensive allocation. I think gold will play that role. Let's go to the fourth reason. Another reason has been the fact that we're entering a deglobalized environment. A deglobalized environment, not only from a perspective of logistics, from a fact that we're seeing reshoring and all those countries having to, not avoid relying in China and other authoritarian regimes, but also we're seeing a financialized, deglobalized environment starting to, or at least entering a phase of those. One of the main reasons why developed economies have been able to run such a long period of time of fiscal deficits is that they've been actually lending money to themselves, meaning, ECB will buy treasuries and then the BOJ would buy sovereign debt from Europe and so forth. So they've been financing themselves for so many decades. And now we're starting to see that with a deglobalized environment, and more tensions geopolitically, we're finally seeing the need for those countries to own a neutral asset. So to me, when I know that central banks used to own a lot more than what they own currently in their balance sheet assets, I can see the case for why we're just getting started in this potential trend. Let's go to the next chart. Here's an interesting chart that I saw that I would like to just supplement the same idea. We've seen a lot of Eastern societies buying gold, as I think other folks have been covering well. And one of the places has been China. And here's the trading volume of gold in China has spiked to levels we haven't seen in the past. And so you can see clearly, yes, maybe it is their central bank and others undisclosedly buying the metal, but also potentially even individuals that are looking to hedge their exposure to their own local currencies that are under threat of devaluing. Remember, I think I said this week. To me, the big short is really the debasement of fiat currencies over time. I think that's really the big short opportunity, in my opinion. Let's go to the next chart. And so another reason that it's been happening is, let's look at more on the micro side. Why do we think that we're entering a gold cycle? Well, if you think about from a supply perspective, I don't think we've ever seen such a constrained environment for gold supply. Arguably, this is one of the worst we've seen since the 1970s. Not only we know that there has been lack of discoveries, which I'm going to touch on that in a second, but also if you look at the existing reserves of gold, they've been also deteriorating in quality. In fact, if you look at the grades, the average grades of most of the gold miners have been in a secular downward trend. If we go to the next chart, what is interesting about this, McKinsey had a great state case not too long ago, in which they reported how much about 1/4, or was that 1/4? I think one quarter of their gold reserves out there are actually refractory, which means they're going to be harder to mine. It's going to be more expensive. They're not the same quality of reserves that we've seen in the past. In fact, if you looked at where we are today, majority of the gold in the world is in two places, Africa and North America. And Africa, as we all know, it's a jurisdiction that is not very easy to mine gold, given the risk, the political risk, and other issues. But the second thing is, if you look in North America, which is a place that has a lot of gold reserves, and you looked at the amount of those gold reserves that are actually refractory, it's almost 1/3, not 1/4. And so it is a large percentage of North America's gold reserves are refractory, which means it's going to be very costly to produce those, and therefore why we think the supply will continue to be constrained and probably provide a much stronger wave of in terms of the pressuring prices much higher. Let's go to the next slide. And you can see here as well, some people like to say production doesn't have a very good relationship with prices. I would argue against that, because history shows us otherwise. As you can see in this chart, going all the way back to 1966, you can see that the white bars are basically looking at gold global production of the miners, and then the yellow line is basically, or I should say, global production in general. And then the yellow line is actually looking at the gold prices, and you can see clearly that in prior periods, then when we had a secular bull market for gold prices, also were marked by a decline of production. And if those existing reserves have a large percentage being refractory and other issues in terms of even the capital being so scarce in terms of the how to attract investors to invest in the space, it's obviously creating more supply constraints. And so certainly this is going to be another portion of that. And not to mention what's been happening with copper and other electrification metals that have been sort of changing the focus of most gold companies to start buying copper rather than gold. That's only going to exacerbate the gold trend, in my opinion. Let's go to another reason why I think this is a gold cycle. Well, we've been here investing in discoveries where we think there's going to be most of the opportunities here in this industry, because of how much they have been neglected even within the industry. I mean, it's easy to find people nowadays, or not easy, but people that agree with the gold thesis will very much disagree with the thesis of investing in junior minings, which is quite interesting. But you can see clearly that a number of gold discoveries above 2 million ounces, we haven't seen many of those in the last 5 years or so. And at the same time, as you can see that those companies have been depleting their reserves. We call this a supply cliff of gold across most of the majors. And although this chart is a little bit old, I can guarantee you that nothing has changed really in terms of finding major discoveries to shift the supply curve in a significant way. And so this is very similar to what we saw back in the 70s. In fact, I think Quinton can provide more context on that. But certainly, at that time, even the valuation proposition of most of the miners were very out of balance from history, meaning the 1970s, the miners are also really depressing valuations. And I can only imagine, I wasn't alive at the time, but I can only imagine people Also being extremely bearish, overly pessimistic about investing in the space, which usually, as I like to say, skepticism tends to morph into opportunity. Let's go to the next chart. As you can see here as well, from a CapEx perspective, is another reason why we think the gold market is entering a bull market. I've never seen a gold bull market start from CapEx cycles being at all-time highs. And today, particularly today, at a decline of about 70% from the peaks levels that we saw back in 2011, adjusted by GDP. And why do we adjust by GDP? Because inflation has is a factor today, much more than even in 2011. We know that the economy has grown significantly, so it is only fair to be doing that. And in fact, if you just look in nominal terms, you also see probably a 30+% decline as well in this metric. But I do think this is a very useful way to understand how much capital constraints we're seeing in this industry, driven by lack of investors interested in the space, and also the difficulty to raise capital as well. And so this is a classic sign of us being as well in the early stages of a bull market, because it basically means that supply will be constrained for a long time. Let's go to the next chart. And then, if you look at M&A transactions, I've also never seen a bull market really start from crazy M&A cycles. Although here it's looking at 2007, we've had actually 17 transactions during that time that kind of carried on later on. On a dollar basis, which is even larger in 2011, 2010, we saw very large, very significant number of acquisitions happen during that time. Today, we're kind of starting to see some of those, but I think it will probably unleash one of the largest M&A cycles we've seen in history, and mostly given the fact that we have seen not only does industry struggle with the quality of their assets, but also we've got segregated too much into too many junior miners. And I think we're going to see a consolidation in a large way that will drive the M&A cycle to levels we probably haven't seen in many years. And not to forget, there's something else going on here from even a government perspective. What we're seeing in terms of the infrastructure developments, is hard to believe we're going to go through all these bills that were being passed that are 3 times the size that we saw back in the post World War II environment, when we're rebuilding the global economy. How in the world do we see all that money being spent in infrastructure without seeing the metals and mining industry consolidate itself, receive most of those funds, become more cash flow positive businesses, and so forth, and also become a higher weight of the overall economy? I think all those things are yet to come. Let's go to the next chart. And so inflation is another reason why I think gold is at its early stages at a bull market. We've shown this chart before, the 3 waves of inflation. Kevin touched on inflation expectations. That's what happens. It becomes a psychological impact in consumers, in businesses. They start raising prices every time they have a problem. And you start seeing that over and over again. It becomes a domino effect. And so inflation tends to occur through waves, as 1970s, 1940s, and even 1910s shows us. And I believe strongly that we're at the beginning of a second wave for many reasons. And as we see that, usually what we learn about inflationary regimes is that investors start to buy hard assets. They start to favor more commodities. Therefore, why you see hard assets outperform things like financial assets during those periods. And so I think that's another main reason, is the early stages of an inflationary era will cause as well this bull market in gold to be in checking that box. Let's go to the next slide. And you can see here another issue is the reckless amount of fiscal spending. But even from a twin deficit environment, where you're looking at as well of how much current account or imports versus exports, if a country is importing more than exporting, and also on top of it is also spending more than receiving in taxes, that's what we call the twin deficit. Twin deficits tend to be very bearish for a currency. And we're seeing this across most developed economies today. I would believe that this is going to be another fundamental reason why hard assets are likely to outperform. And as I said before, the big short is the devaluation of most fiat currencies relative to things like gold, things like copper, silver, and so forth. And I think this is an important one. Today's levels of twin deficits to GDP are somewhere close to where we were at the depths of the global financial crisis, to put this into perspective. If you're a technical person, you're looking at this and it's making higher lows. Well, it's probably going to hit another low here as we see a recession unfold or some sort of economic contraction. The next economic contraction will probably take this even further down as we see the deficits spending, exacerbate this metric in a large way. Let's go to the next chart. And so, many reasons why I think that we can say, and I'm saying this is my opinion, that I think we're going to enter a time when we're probably going to see stupid gold prices. When I say stupid is because usually when I talk to people, they always want to know what's your target prices. I have no idea what a target price is for gold personally. I mean, I can try to design that looking at money supply. I can look at monetary base. I can see kind of relative to the S&P 500. I can see at prior cycles how much it tends to increase, and I can have an idea today. But I sort of think what we're experiencing today is sort of unique in the sense of I don't think we've ever seen a trifecta of macro imbalances, the inflation, the debt, and the valuation problem we're facing today. This is why I think a lot of people are going to flock into the metal over time, especially if we see things like yield curve control, a debt crisis, a complete loss of faith in treasuries and other sovereign debt instruments. All those things are sort of open to. I'm very open-minded to those things because I think that they could happen. Maybe the dollar becoming even more challenged as a reserve currency in the future. I think there's all sorts of things that could potentially create a real big movement in gold like we haven't seen since the 1970s. And as we see that occurring, it's hard to believe. It's really hard to believe that you can see the metal price rising in like I said, to my opinion, in stupid levels without causing the fundamentals of the businesses that mine gold to actually see those changing. Therefore, if you go to the next slide, you can kind of see one of my favorite sentences or quotes is "Bull markets make you money, bear markets make you rich," by Steve Hank. And it's a great quote. There's many quotes that sort of explain or express a similar idea of buying low and selling high and having that conviction of accumulating an asset at such a depressed level when everybody disagrees with you. I love that sort of when I can find a thesis like this where I can put 15, 20, 30, 50 charts supporting my thesis, and at the same time most people disagree with me or us, and to me this is where the real opportunity lies ahead. And so looking at even juniors versus seniors as a way to sort of measure this neglection that we've seen in most of the small cap names in the industry, you can see clearly that we've been in a downward trend for so many years or decades. And now we're finally seeing a movement that kind of shows that perhaps we're starting to bottom in this. It's too early to say, but given everything I said here in the earlier slides, I really believe strongly that I would doubt that a gold market wouldn't be unleashing here in a secular bull market without causing this chart to break out and other charts like the gold miners to gold or gold to silver and so forth. I mean, I can go on and on. I try to keep this relatively short of the reasons why we think that we're going to see a gold bull market. I could probably go on with more slides, but these are the main reasons why we think that this thesis is solid and it's a long-term one that we want to take an activist approach and work so closely with a guy like Quinton. Let's go to the next slide. Now, silver is an interesting metal because now I've been of the belief that silver will outperform gold in this next gold cycle in a very significant way. And it surprises me that we have the gold to silver ratio still at 80, given how much gold has been moving already. Now, notice this difference between the movement we're seeing today versus, the prior movements we've had here in the last 5 years. If you recall, we had the COVID crash, which shows in this chart, and then we had a pandemic surge where a lot of hard assets actually surge in prices. And then we sort of declined from there at the later parts of the year. August was the very peak of that chart. And then again, we had another big movement that was called the silver squeeze, per se, was in, I believe, February of 2021. And then prices never came back to those levels. those are sort of short-term spikes that we've had in silver prices. And today we're seeing, doesn't look like a short-term spike to me. It looks more like a sustainable movement to the upside. This is what I like about silver, is that no one is seeing this. I don't think a lot of people have realized that we're actually trading at those levels already of the silver squeeze that everyone was referring to, that we had such a level of speculation, short-term driven at that period. And today it's a much more sustainable movement. If you ask me where we're going from here, we're probably going to go back to the 50s and much higher, but that's just my opinion. And I think that the time to be accumulating assets that have leverage to silver were not only a year ago, but now, because we haven't really seen those movements on triple digits. You don't acquire assets at cheap levels, after the fact. You do that before those theses begin to unfold. And I do think this is going to be the case here. This is why it's my favorite metal when I try to at least pick one. But I do like all sorts of metals. And the prior presentation, I went through many different hard assets in gold prices, so you could see how most of the commodities are actually really cheap relative to gold, or meaning they're really cheap relative to inflation, if gold should be assumed as the real or true inflation rate that we should be measuring those things against. And so that's certainly the case. If we look at oil, we look at copper, zinc prices, all of those things are highly depressed historically, and which gives me the sense that if I believe in gold prices moving higher, then I think a lot of things need to be repriced much higher too. And that's the miners, that's junior miners, and that's other metals that tend to move along with gold as well. Let's go to the next chart. Now, interestingly, I've been pointing out the natural gas opportunity here recently. Again, it's another contrarian opinion, another thing that, I put out this chart and people, came after me and said, well, are you not seeing the supply, glut that we have in the natural gas space and so forth? And that was certainly the case also when oil turned negative, where folks would come out and say, things that were, basically, I like to say a sentence sometimes, which is, tell me something new, something I don't know. And, the fact that we, that there is a supply glut, well, that's already well known in the price, as you can see here. In fact, we're hitting, a low in this commodity, although it has been rising recently. We're hitting a low in this that we've only seen in 7 other major bottoms. But you can see the main point of this chart is showing the future curve in the second, basically looking at a long dated contract versus a short dated contract, and you can see that we're seeing a very large contango in natural gas prices. Now, okay, keep that in mind. We're seeing a large contango. Prior contangos also marked a major bottom for natural gas prices. Guess what else is showing a contango? Let's go to the next chart. Silver prices are also showing a contango, not as cyclical as natural gas, because natural gas is just, if you think silver is volatile, let me welcome you to look at natural gas prices. It's like 50 times worse. But you can see here that this chart is such an important chart, also showing exactly the same thing. Future curve is in a massive contango today. We have the gold to silver ratio also at 80. We know that the supply remains very constrained for silver in places like Peru or even Mexico, which account for most of the production globally. We measured this as well here at Costa, and it's really interesting to see how a lot of people continue to neglect the metal, and we're seeing a change here in this environment. The sustainable movement we're seeing in silver, to me, it really is aligned with the big story, which I think a lot of investors are ignoring as we see silver prices continue to confirm this breakout that we've seen recently. And I think we're going to go much higher. This is what gets me excited. Let's go to the next chart. Now let's talk a little bit about the economy, which is related to what I just said, and then we're going to go into Quentin. Here's a freight cost is an important thing. It's what causes inflation a lot of times is things like this. And we've had a first wave of freight costs globally actually happen, and then recently we have started to see a second wave, mostly caused by the Red Sea. And there was a decline short term, and now we're starting to see another inflection higher. This is the Shanghai index, so it's mostly Chinese a way of measuring this the freight cost by containers. Now, let me point out that this index tends to lead global freight cost. And I do think that we're likely to see a reacceleration of this price that will also have global impact in terms of inflation. I think this is such a critical chart to be looking at. If I was a central bank, I would be. I know Fed had a few statements, or Jay Powell had a few statements last week saying, I don't see the stag, I don't see deflation. Well, here's deflation if you want to know. And let me show you the stag in a minute. Let's go to the next chart. I'll show you in a second, but look at the 2 versus 30s, basically the steepening of the yield curve. Another thing we've been talking about here, we're so close from a breakout in this chart. I think it could happen any moment as we pop from this, just like silver, just like gold. I think we're going to gain momentum. And remember, when you see the steepening of the yield curve unfolding, that usually is aligned with the recession as well. So I'm paying really close attention to this. This is maybe the stag for Jay Powell that I would be paying very close attention to. And not to mention, regardless of what happens with politics and so forth, to me, it sounds like both candidates are going to have to force the 2-year yields and the short-term yields lower at some point. In other words, instructing the Fed essentially to be cutting interest rates or having interest rates at a more affordable level. And at some point, we may see actually this inversion of the steepening of the yield curve inversion being caused by the fact that by suppressing short-term yields and letting the long end run because of inflation and the risk of inflation and supply glut and so forth of treasuries, we may actually see this steepening of the yield curve gain a lot of momentum. And so I'm paying close attention to this. This chart is looking better and better every day. And today it's not working very well. Yesterday, for 2 days, it worked really well. I think we're getting really close to something special in this chart. Let's go to the next one. Here's another one for the stag. So you can add to your folder, Jay Powell, which is looking at the unemployment rate. This is such an important chart. And probably the takeaway from the prior week's labor data was the fact that labor markets or unemployment rates ticked up again. And look at this chart. Every single time this index crossed the 2-year moving average or the 24-month moving average, we actually had a recession or at least the beginning of a deterioration in labor markets. So, well, this is another one to be paying close attention to as part of this the stag situation. Let's go to the next chart. I'm almost done. And you can see that about 2/3 of employment today comes from small cap companies. This is a chart I want to point out again. This is diluted earnings of large caps in white, small caps in red. And you can see the divergence between the two. Small caps fundamentally are not improving as the large cap companies. Therefore, you're seeing that those companies not making much money and starting to see a real contraction of their earnings likely will have an impact as well on labor markets. And so this just adds to that case of the prior chart. I think this is such an important aspect to be looking at as well. And, one of the main reasons why we've seen the small caps actually lag relative to large cap companies, and I'm talking more not mining companies, I'm talking about more broadly about the markets with the mega cap stocks versus the Russell 2000s and so forth. Although we're seeing a similar phenomenon in the mining space, I'm referring to the broadly speaking about the market. Let's go to the next chart. And I think this might be my last chart, but this idea that I guess Druckenmiller was talking about, which I agree fully, which has to do with the stagflation. This is looking at the number of times that stagflation has been used in news stories on Bloomberg, and it's been starting to rise again. And it's claiming that we have a weak GDP and a hot inflation figure today. I would agree with that. I think stagflation is a highly likely scenario. Not to talk about politics, and I'm just paraphrasing what basically Druckenmiller said. Druckenmiller said, regardless of what candidate, we're probably going to see either stagflation or inflation. And I'm paraphrasing him again. I think we're going to see CPI rates of north of 6% perhaps in 2025 if Trump gets elected. And I think he talked about more of a stagflationary environment if Biden gets elected. I think it's a really interesting thought. And to me, I do think stagflation, regardless of who gets elected, and Crescent is not necessarily positioned for who is going to win elections in this in the next few months. But what we're really doing here is trying to understand the macro environment and what type of economy those candidates will be inheriting as we move forward, and most likely a very an inflationary environment that's very embedded in the system. As we see growth becoming harder and harder to be created, I think this is going to be the story of the next year or so. And as we see that happening, it's hard to believe hard assets and others will not take place in terms of being more favored by most of investors. So I hope I provided some sense in terms of why the junior miners are lagging, why I think it's so important to check the box of being in a secular bull market for gold, because that's the only reason why this time will not be different. Is if indeed we are in a bull market, then I would say that most of those laggers are actually, Kevin, it will probably be right that the lag is your friend, because if it is a beginning of bull market, boy, a lot of things are very mispriced.